Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge Weekly Podcast. Today's date is the 23rd of March. Let's dive into the week's top market news. European markets rattled by Middle East tensions and energy shock. European equity markets endured a turbulent week, with the Pan-European Stocks Europe 600 index shedding 3.79% in local currency terms as investors grappled with a dangerous escalation in Middle East hostilities. Attacks on oil tankers in the strategically vital Strait of Hormuz and damage to natural gas terminals in Qatar sent energy prices sharply higher, reigniting fears of an inflationary spiral that policymakers had only recently begun to bring under control. The sell-off was broad-based and unsparing. Germany's DAX bore the steepest losses among major indices, closing down 4.55%, reflecting Berlin's acute vulnerability to energy cost shocks given its industrial base. Italy's FTSE/MIB declined 3.33%. France's CAC 40 retreated 3.11%. And the UK's FTSE 100 fell 3.34%. In a matter of days, months of cautious optimism were unwound as geopolitical risk repriced across the continent. Against this unsettled backdrop, the European Central Bank held interest rates steady at its Thursday policy meeting, yet the tone from Frankfurt was far from reassuring. ECB President Christine Lagarde was candid in her assessment, warning that surging oil and gas prices will have a material impact on near-term inflation and pledging close attention to incoming data to calibrate the bank's next move. The ECB revised its 2026 inflation forecast upward to 2.6%, a significant jump from the 1.9% projection issued just 3 months ago in December. That figure carries additional weight given that annual Eurozone inflation had already climbed to 1.9% in February, precisely at the ECB's target, before the latest energy shock took hold. The Swiss National Bank and Sweden's Riksbank similarly opted to hold rates, underscoring a continent-wide posture of watchful caution. The macroeconomic picture was further clouded by weaker trade and production figures. Preliminary Eurostat data showed the euro area's goods trade deficit widening to €1.9 billion in January 2026, compared with a deficit of €1.4 billion a year earlier and a surplus of €11.2 billion as recently as December 2025. The deterioration was driven primarily by falling exports in machinery, vehicles, and chemicals, sectors that form the backbone of European industrial competitiveness. In Germany, producer prices fell 3.3% year-on-year in February, a steeper drop than analysts had forecast. While the decline primarily reflected lower gas and electricity costs at the time of measurement, the figure underscores the sensitivity of Europe's largest economy to energy price volatility, both as a deflationary force when prices fall and as a crushing burden when they rise. Across the Channel, the Bank of England's Monetary Policy Committee left its key rate unchanged at 3.75%, in line with market expectations. However, the central bank echoed the ECB's cautionary tone, warning that a prolonged energy shock could reignite inflation and ultimately compel a tightening of monetary policy. In parallel, the Prudential Regulation Authority put forward new proposals aimed at strengthening bank liquidity and resilience during periods of financial stress, a signal that regulators are preparing for scenarios where the current turbulence deepens. The outlook for UK industry adds another layer of concern. A report by Make UK, the country's manufacturing sector body, flagged declining domestic orders and rising input costs as growing drags on business confidence. a reminder that the challenges facing European economies extend well beyond the trading floor. Now our insight into alternative markets. 7 megatrends for the future. The transformations reshaping the global economy. The world is in the midst of a silent revolution. 7 structural forces, identified by Stephen Friedman, Head of Research and Sustainability at Pictet Asset Management, are redefining production, work, and consumption models for the next decade. Understanding them today means anticipating the opportunities of tomorrow. Longevity and Health 4.0. Population aging is no longer simply a demographic challenge. It has become a growth engine for the entire healthcare ecosystem. Prevention is emerging as a strategic priority for governments, companies, and individuals alike. And artificial intelligence is enabling more precise diagnostics and more effective screening programs for age-related conditions such as obesity and cancer. According to Deloitte, proactive investment in disease prevention could guarantee every American citizen 15 additional years in good health. Against this backdrop, the digital health market is expected to exceed €21 billion by 2030, making longevity one of the most consequential investment themes of the coming decade. Agentic AI and productivity. Generative artificial intelligence has ceased to be an option. In 2026, it has become infrastructure. AI code assistants have already increased software developer productivity by between 20% and 40%, while agentic AI services now operate at scale, performing complex tasks autonomously and without human intervention across customer service, logistics, and biotechnology. This year is widely regarded as the moment of digital maturity, the point at which AI technologies become structural and, in many contexts, invisible, embedded in the fabric of how organizations function rather than deployed as a visible tool. The rise of robots. Robotics is reaching a historic turning point, accelerated by its convergence with generative AI. The installation of 619 million industrial robots worldwide is projected for 2026, up from 575,000 the previous year, as collaborative and humanoid robots expand their presence in factories, data centers, and environments hazardous to human workers. Autonomous vehicles are making their debut on the streets of London and other major urban centers. The sectors most affected, automotive, logistics, healthcare, and industrial manufacturing, are being asked to rethink their operating models from the ground up. Healthy and natural food. The global consumer is shifting toward more conscious food choices, and this is driving a deep transformation of the food industry. Demand for natural, local, and minimally processed ingredients is rising steadily, reinforced by movements such as Make America Healthy Again and by increasingly stringent food labeling regulations. Next-generation weight loss drugs based on GLP-1 mechanisms are further reshaping nutritional habits, reducing consumption of ultra-processed foods and compelling food companies to rethink their recipes, marketing strategies, and supply chains in order to remain relevant. Energy storage and renewables. The energy transition is advancing, but the real bottleneck remains storage. Global energy storage capacity is growing at 23% per year according to Bloomberg NEF, spanning large-scale batteries, hybrid wind and solar installations, and a range of emerging technologies aimed at overcoming the inherent intermittency of renewable sources. Nuclear energy has returned firmly to the agenda. Major American technology companies are looking to it as a stable and reliable power source for the energy-intensive data centers that AI infrastructure demands. The company's best position will be those that solve not just generation, but storage. Climate resilience. Adapting to climate change has become an economic imperative, not merely an environmental one. In the past year alone, the world experienced over 150 extreme weather events, with economic losses estimated at $320 billion, some 40% above the 10-year average. Governments are responding with investments in resilient infrastructure, including rainwater management systems, building retrofitting, and efficient urban cooling. Early warning systems for floods and wildfires are being extended to new geographies. For businesses, the calculus is becoming clear. Companies that invest now in adaptation and resilience will secure a lasting structural competitive advantage over those that do not. Cybersecurity in the AI era. Information security has become an existential priority for organizations and individuals alike. A cyber attack occurs every 39 seconds, and millions of data records are compromised every day. Large language models are increasingly weaponized for sophisticated attacks, to the point where phishing emails containing spelling mistakes are now the exception rather than the rule. In response, defensive AI is learning to protect systems from the very machines used to assault them, through predictive analytics and automated threat response. According to Gartner, global cybersecurity spending will grow by nearly 14% per year, driven by the development of advanced defensive technologies capable of keeping pace with an ever-evolving threat landscape. These 7 megatrends do not operate in isolated silos. They fuel and amplify one another. AI enhances robotics, robotics accelerates industrial resilience, and cybersecurity underpins the integrity of the entire system. For investors, managers, and professionals, understanding these dynamics is not an academic exercise. It is a practical guide to anticipating where capital, talent, and innovation will concentrate over the next 10 years. The silent revolution is already underway. The question is whether organizations are positioned to lead it or merely to follow.
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, thubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.